Hello, everybody, and welcome to the Inside ETF's weekly webinar, What's Driving the ETF Theme Worldwide? My name's Matt Hogan, and I'm the CEO here at Inside ETFs, and I'll be your host for today's webinar. You know, the massive growth of ETFs in the U.S. gets all the attention, but ETF assets are surging in nearly every market around the world. Global ETF assets turned up an astonishing 36% last year, thanks to both strong performance and strong net inflows from investors. What is it about ETFs that make them attractive in the U.S., Europe, Canada, Asia, Australia, and many other regions? And what can we learn about developments in those areas that will color how we think about ETFs and investing and the future of both ETFs and investing here in the States? Joining me to talk about this and more are two exceptional leaders in the global ETF space. Deborah Furr is managing partner and co-founder of ETF GI. She's a global expert on ETFs with over 20 years of industry experience in financial products, 15 of which have focused on ETF and ETF exposures. Deborah was previously the global head of ETF research and implementation strategy at BlackRock, Barclays Global Investors, from 2008 to 2011. And was managing director and head of investment strategies group at Morgan Stanley's for 11 years prior to that. Joining Deborah and I is Daniel Wallach. He is principal investment strategist for Vanguard's investment strategy group. He develops solutions for institutional clients and has a passion for portfolio construction, which led him to be instrumental in the development of both Vanguard's capital markets model and its $700 billion plus target retirement funds. He is a great speaker on ETFs and index-based investments, and delighted to have him here as well. Also delighted to have everyone joining in from the audience. The way these webinars work best is if you consider yourself an active participant in the webinar. There's a Q&A button at the bottom of your webinar viewing browser. If you click that button, you can open up a toggle window which will let you ask questions of myself, Deborah, or Daniel. And I'd encourage you to ask them now. Ask them as soon as they occur to you. I'll collate them at the end of our discussion and answer as many as we can before we wrap up the half hour. Now, we do these webinars in two parts. One is the roundtable discussion focused on the big picture topic of what's driving the ETF theme worldwide. And the other is a little game we like to play called 5 Questions in 5 Minutes. Daniel is going to be our 5 questions in 5 minutes candidate. So, Daniel, first of all, welcome to the webinar.
Thanks very much, Matt.
All right. So I have a stopwatch by my side. I'm going to click over to the next slide and ask you the first of our 5 questions, and we'll try to get this 5 rapid-fire questions in, focused mostly on active and factors, which were a big discussion point at the recently concluded Inside ETFs. So I'm going to start my timer now. So, Daniel, Vanguard is best known for creating the index fund industry, but it has significant active fund business as well. How does Vanguard think about active and passive? Can they coexist?
The short answer is yes. So Vanguard has about $1 trillion of actively managed assets. That's probably one of the better kept secrets in the industry. And when we think about investment principles, we don't think of index or active. We think about goal, balance, cost, and discipline. So the key element there probably is cost. You can acquire either one with a reasonable cost. They have an opportunity to ultimately help you in your portfolio.
Okay, but most active managers underperform the market. Is controlling for cost enough to make sure you get funds that will do well?
Well, it's interesting to think about underperforming the market. Most managers will if you count them. If you weigh them, the odds are about 50-50, which is on a gross basis, which is what the theory would say. The key driver off of the gross 50-50 number is cost. So cost is the thing that will drive you well below the probability of a 50-50 outperformance of the benchmark. So we think there are ultimately 3 things that matter. It's talent, cost, and patience. Talent by the manager, low cost with that talented manager, and then patience by the investor ultimately, because no manager will consistently outperform the market. You have to have patience to live with the variability through time.
Let's talk a little bit about that variability on question number 2. And this came up for sure at the conference quite a bit, which is, I keep hearing that 2018 is supposed to be the year for active. Is it true, and are there good and bad markets for active managers generally?
Well, I've heard that 2018 is going to be the year of active, and I've heard that 2017 was going to be, and 2016. I think every year there's somebody who can rationalize why this year is going to be better. I guess based on the research we've done, we would say there's no particular market, and there's no particular section of the market that, there's no time or section of the market that is particularly better than another for active managers. It's really other factors that drive that. And you can have talent in any form or any location. You want to combine that, as we mentioned, with cost, and then have the patience to live through time. I think if you try and time over the short term when a manager is going to be effective or not, it's going to be very difficult to be successful.
All right, fantastic. I'll move on because of time. With the rise of factors in big data, what's left for active managers? Where can they legally find edge in today's big data market?
So 2 quick ways to answer that. One is, if you think about the 3 big choices that are available for clients, you can think of market cap weighted indexes, traditional active, and somewhere in the middle is that factor that have been introduced and are so increasingly popular. But there still is the opportunity, I think, for active managers to add value, either with factor rotation or through security selection. Yes, it is harder because there's the greater decomposition of where their returns come from, but it's still possible.
All right. And do you think it's going to get harder and harder as that decomposition continues, or have we reached the apogee of that difficulty?
That's an interesting question to talk about. So when you think about factors, there are really 2 ways to consider them. One is an after-the-fact attribution of what a manager has done. The other is a beforehand substitution. Those are 2 very different things. The attribution's easy. The substitution's a bit more difficult. And so I think there's still a role to play for the traditional active manager who can not only take a beta exposure and a factor exposure, but a security selection exposure as well.
All right. I've asked too many questions, so I'm going to extend this an extra minute. So we have 2 minutes left.
Okay.
Question 4, is there a benefit to combining active and passive portfolios? And I know you have some data on this.
Yeah, there really can be. And if we're able to go to your slide 9, I think this is a visualization that might help people a bit. When we think about this question, we think about, first of all, do you have the access and the ability to identify talented managers? And if you do, then there's the second level of we want to be explicit around what our expectations are with that manager to be able to figure out how much active versus passive we should identify. And specifically, when we're talking about being explicit, we're talking about a gross alpha expectation, a cost of the fund, a tracking error of the fund, and then, again, our personal risk profile for how much variability in those outcomes we're particularly comfortable with. That's ultimately how we see about trying to think about how do you combine the 2 active and passive together.
All right, great. We have 1 minute left. I want to save time for this last question. This conversation could easily take 20 minutes with the follow-ups I want to do. But what makes factors different from size and style? And I ask this because Vanguard has launched passively managed size and style products and actively managed factor products. So what is the difference?
Right. So you can think of it like a Venn diagram where they can overlap and there can be differences. You can have a factor that is style, say a value factor. The question is, how do you construct that factor? So you can either do it as a market cap version, in which case the market is really driving a good portion of those returns, or you can sort on the pure factor by security. And there's value in that sort of more active approach to the factor acquisition as well, because you're skewing out a lot of the market. So you can think of it as a Venn diagram, these 2 overlapping elements. One is, what is the factor that you're trying to reach? And the second element is, how do you try and reach that factor?
All right. I love it. Well, that takes up all our time for 5 questions in 5 minutes. In fact, we used 6 minutes. But thanks for that, Daniel. We'll follow up on that during the conversation. I'd remind the audience, if you have questions about those 5 questions we asked and Daniel's answers, or about the rest of this discussion, please enter them into the Q&A toggle at the bottom of your webinar viewing screen. But I do want to bring Deborah Furr in to kick off the main part of our conversation, which is what's driving the ETF theme worldwide. And Debbie, I was on your site ETFGI just before this webinar, clicking through the asset charts for U.S., Europe, Asia Pacific, Japan, and Canada, and they've all had a massive tick up in the past year. So I guess the opening question to you is, what is driving the ETF theme worldwide? Why is it successful in almost every single market around the world?
Hey, Matt, that's a great question. So I think that ETFs have been embraced as a tool by all types of investors. So you find that institutions use them, financial advisors, and then retail for very different reasons. So some people use it short-term to equitize cash. Others are using it to tactically adjust to news, political or economic, that are happening in the market. Others use ETFs as long-term core holdings. And what we found is that many investors, because they want to invest in so many asset classes and so many different markets, find it hard to identify tools or solutions or ways they might generate alpha. And so they've moved to seeing ETFs as a solution to help them generate alpha through asset allocation, as opposed to doing it through trying to find individual funds that do it, or even hedge funds.
I think that's definitely true. I guess my follow-up question, and one that I wrestle with a lot, is why ETFs and not index funds? And I'll ask the same question to Daniel, but I'll start that with you, Debbie. Why specifically into the ETF structure?
Well, so in general, you do find that in the U.S., ETFs are more tax efficient than index funds, so that's a benefit. ETFs tend to have smaller minimum investment sizes to invest than many index funds. The array of exposures and benchmarks that are available are much larger. And I do think that people have bought into the idea that it's nice to have the opportunity to adjust your allocations when you want to. And so with many index products, you can be locked in. Sometimes in Europe, we find that, or even in Asia, funds will gate, which means you can't go in or out for some period of time. You can suffer penalties. So I think that ETFs in general have been embraced as a simple, transparent, cost-efficient way to easily get exposure to what you want to when you want to do it.
Absolutely. Now, Daniel, obviously Vanguard offers both ETFs and index funds. Often actually the same fund with different share classes. I guess, how do you see the use of those two differ in different geographies around the world? Are people using them for different things? Are they favoring one over the other? What do you see?
Well, I would agree with what Deborah just said. I think she did an excellent job of describing sort of why people are doing it. Maybe let me add two other things to supplement that. So one other reason why people do it is, and Deborah alluded to this, is the security nature of an ETF, where you can buy it like you could buy a security. And for some people, there's an ease of use in doing that. And so there's that mechanical aspect. The other thing that, just to reiterate what Deborah said, one of the great growths we've seen in ETF growth is this sort of, although it looks like a lot of passive investing is being purchased through ETFs, we actually think a lot of it is these sub-indexes similar to factors. And so people are using it exactly as Deborah mentioned, which was to take control of the asset allocation structure and be much more proactive in that, rather than deferring all of the alpha generation to a third party. There's a greater control by thinking of this in terms of valuations of factors or tilts or regional tilts or any of that. And you can execute that structure in an ETF as well.
Absolutely. Now, David, back to you. You're headquartered in London, but you're everywhere around the world, so you know all the different markets. Europe had a huge year last year. I guess for the people out there who don't know, talk to me about the big differences between the European ETF market and the U.S. market. And are there different investors using ETFs in Europe for different reasons? What do you see when you compare those two?
Yeah, so there's some pretty significant differences. Clearly, the U.S. is easy from the perspective that it's one country, one language, one tax system. ETFs are more tax efficient. You tend to find that the financial advisors have embraced using ETFs and are encouraged to do so in many cases. When you move to Europe, it's many different countries, many different sets of regulations, tax, currency, investor preferences. In many cases, in many markets, investors have not embraced using even mutual funds, where in the U.S., because of the 401k system, most investors will have mutual funds in their 401k, will have a brokerage account, and so you see significant differences in terms of how much money is actually even invested in the market. What we have seen also is that it's changing now after a new set of regulations that went into effect just this month in January. But historically, many financial advisors were paid to sell different types of products, and ETFs don't pay advisors to sell them. So you found that ETFs in general in Europe has tended to be much more of an institutional product and not really used by financial advisors, which also means then that the retail market has not embraced ETFs in the same way it has in the U.S., because often retail speaks to advisors, and if they're not using ETFs or familiar with them, they're more likely to convince them to use a different product. Mm-hmm. Having said that, regulations are changing, and so we expect financial advisors now, after a new set of regulations called MiFID II, will start to embrace ETFs more. So we do see the future for ETFs in Europe as being quite bright. And last year was a great year in terms of growth in assets and growth in net new asset flows and number of new users across the countries and by different types of investors. But we're probably, I would guess, 7 years behind the U.S. in terms of adoption and the way ETFs are being used.
Right. Well, that would be just fine, since I think ETFs launched in Europe 7 or 8 years after they launched in the U.S. So it's ticking along. I guess, Daniel, how do you feel about the European opportunity? Is Vanguard bullish on that space? How is the Vanguard project going in Europe? Do you think these regulations will help? What's your view there?
Yeah, so I definitely think the regulations will help. So overall, very bullish on Europe. A couple things to add to the conversation. So one, the U.S. also has a very long history of direct retail investing and direct investing. And again, there's a lot more intermediary business in Europe. And so whereas ETFs and everything else would be directly sort of self-directed in the U.S. by retail, there's a third-party element. And there's these platform structures that you have to work through. I do think the global regulation, in Europe, but globally around the world, is trying to get to focus on cost and transparency and fiduciary responsibility, and all of that will drive for more efficient products and processes, and ETFs will be, I think, a useful tool within that process. So yeah, we think future's just even sort of going to be a greater process of use for ETFs around the world.
Yeah, absolutely. I want to get to the risks that could retard the growth of ETFs, but first I want to hammer in on a few things our listeners might not know about these markets that are different than the U.S. And I'll start with you, Debbie. There's a real big difference in Europe in terms of how ETFs are traded. I guess, can you walk through what those differences are in the audience, and then also talk about sort of the rise or importance of NAV-based trading in Europe and how that process works? Because I don't think people in the U.S. understand that all very well.
So in Europe, ETFs are listed on over 21 different exchanges. So part of the challenge is if someone buys an ETF, say, on the London Stock Exchange and then wants to sell it on the Deutsche Börse because an ETF might be cross-listed there, they actually have to, the broker does, move the securities in the depository from one, what's called CSD, Central Depository, to another. So a lot of pipe work has to happen in Europe that doesn't happen in the U.S. We don't have guaranteed settlement the same way you do in the U.S. through DTC. The other big challenge is that in Europe, we've seen that there is a requirement for best execution. And what that's meant is, for many investors, they are using requests for quote platforms. And when people go to those platforms to get a price and decide to trade there, that means that the trades are being done off exchange. And so we've seen that in general, over the past few years, most people would estimate that 70% of the trades are being done in Europe on an OTC or over-the-counter basis and not directly on the exchanges. It's also been difficult to see where trades are happening because of reporting requirements in the past, and we don't have a consolidated tape to show you what's happening. One of the things we've seen is that as financial advisors and people who normally use mutual funds move to using ETFs, they're not so interested in trading during the day and are more used to, as they do with mutual funds, wanting to trade at the net asset value or NAV trading, as you asked. And so that was something that we started to see in Europe probably 4 years ago. And I can remember in the US when people heard people in Europe wanting to trade at NAV, that sounded like a very bizarre concept. I think as we've seen around the world, more financial advisors embracing ETFs. Many of them will ask for NAV trading up in Canada, in Asia, because it's the way they're used to and comfortable investing in mutual funds. So Europe has multiple currencies, multiple exchanges, so it is more complicated than the US market, and you have different products listed on different exchanges. So a lot of differences. Probably that's enough to give you a sense.
No, that's great. That's a great overview. And Daniel, I guess I'd raise to you, are there any areas when you look outside the U.S. where you think, there are things for the U.S. to learn from those ETF markets? Any advances in Canada and anything in Europe, anything in Australia that we from the U.S. could, should, would admire and want to replicate, or are the ETFs industry moving along at the same pace in all those markets?
Well, what I mentioned earlier was more along the lines of regulation, where I think there is this sort of global trend for how do we articulate, proper fiduciary responsibility and a sort of a measurement of that sort of transparency and cost, that the cost structure is really becoming sort of a universality. And to the extent that ETFs are an efficient way of delivering on that, I think they'll be benefited from that structure. I think the other element is, and these are sort of global trends, right? The other one that we talked about before is this element of factor investing being available through ETF structure and allowing financial advisors or managers or individuals to have a greater control over the portfolio construction. This has led, I think, to an increased consideration of off-market cap construction and sort of a widening of that. And there's becomes this sort of it's a global reinforcing of the ultimate change. And while the U.S. is a very large, is obviously the largest market, a very large market, I think this global interconnection of all of these investments sort of it's impossible for us to be independent of whatever that sort of global trend is.
Absolutely. I do want to dig into factors and active as a potential, next shoe to drop in the ETF space. We did have one question on your presentation, Daniel, which I'll ask directly, and then we'll expand the conversation to talk about global growth. The questioner asked this. Some critics suggest factor selection can be attributed to data mining. Can you comment about that? Which I presume they're talking about, sort of the historical outperformance of different factors being as a result of isolated data mining. Is that a fair accusation? Is it not? What would you say?
Yes. In fact, a colleague of mine, Joel Dixon, has published a paper exactly on that, where what you have to be careful of is some new way of weighting whatever the securities are that has a fantastic back test that is all paper-driven, and then the actual investment is pretty mediocre. And there's a long history of, the reason a lot of investments can be created, particularly unusual ones, is because it has a brilliant back test, but the actual future investment is fairly mediocre. And so that concept is, yes, I would be caution everybody there. If you're going to be thinking about whatever the investment structure is, whether it's market cap or some other form, you want to do that in a very intentional way, as opposed to simply taking a structure that somebody else has developed. You could think of smart beta as an example of that. Smart beta is the concept there is there's an embedded size and style tilt in that. If that's what you want, you can go build a size and style tilt. Just think about it in a conscious effort way and make it intelligent. But yes, there's absolutely a long track record of back tests not performing in the future.
Yeah, some great articles on that, including the CAT portfolio from Bloomberg that delivered 1,000,000% returns. We got about 5 minutes left. I want to ask Debbie to gaze far into the future on factors and smart beta and even active ETFs. To date, the majority of the flows have been into traditional cap-weighted index funds. Even in recent years, those have dominated the inflows. As you look out 5 years, 10 years, do you see factor-driven ETFs? And separately, do you see actively managed ETFs being a meaningful part of the ETF asset mix? In other words, not 3 or 4%, but 30 or 40%?
So that is an interesting question. I think the trend that we're seeing now is, well, it partially comes down to what do you call a factor and what do you call smart beta. A lot of investors are now embracing ESG factors, and some would even say that's smart beta. So I think people are looking at companies that tend to think about better governance, tend to perform better, which historically, if you remember back, it used to be people would weed out the sin stocks, so tobacco, firearms, pornography, and tobacco stocks, as an example, have very high margins, so tended to perform better than many other stocks, and often people would go back to investing in tobacco. So I think people are very interested in the lens of ESG, which could fall into that factor, and I think that will continue, especially among millennials and people concerned about leaving a good world for their children or grandchildren. Active ETFs is an interesting one. I think that one really comes down to what does the SEC see as the benefit of active ETFs for end investors. And I think the jury's still out on whether they see that as being really beneficial. I think one of the challenges, even if active was embraced within the ETF wrapper, and it's important to think of the ETF as a wrapper, one of the challenges is right now in the U.S., because you can't buy easily a fraction of an ETF within 401k plans, it does make the broad appeal within one of the larger pools of mutual fund assets challenging for ETFs. And most people would say, well, I don't need intraday trading in my 401k plan. So we haven't seen that market open up. And so even if active did get embraced, you have to think about how do you get ETFs in a meaningful way into the 401k product set, and does it make sense to do so? So I think at some point we'll tend to see more active, and many people think smart beta and factors is active. The other challenge, though, is if we go back to something that Daniel discussed in the beginning, is one of the big challenges is most active mutual funds don't consistently deliver alpha. And when people look at active, they'd like to see 3 years of track record and $100 million before they invest. And so getting over those thresholds makes it challenging if someone launches a new active ETF. So I think there's a number of challenges for active, although having said that, I still believe the ETF industry in the US and globally is going to grow quite significantly. And I think we'll see a lot of new structures inside of, or exposures inside of ETFs. But I think the active one is a little bit difficult to see because I think some of the comments recently have said some of the non-transparent models that are out there could be reversed engineered and therefore could be front run. And that's one of the big concerns among the fundamental active portfolio managers is they typically haven't wanted to tell their secret sauce to the world. And so I think as we look at some of the new regulatory changes that might come out from the SEC, potentially saying they want daily transparency on all ETFs, that would push active managers away from launching ETFs, at least in the short run.
Yep, absolutely. Great. I mean, great comments. I do want to turn over to Daniel with a similar question. Both first, as you look out 5 to 10 years, do you see a significant place in the ETF ecosystem by assets for factor? And then on the active front, the same question. And what are your thoughts on the need for full transparency in actively managed ETFs?
Right. So taking that last question first, I think that's the challenge, and I think Deborah described that well, and I think that will ultimately always be some of the challenge. But let's just start from sort of step one, like how does one define active? So I think there are many types of active, and we often talk about that in the traditional sense of an individual manager picking stocks. But if you're asking me, I think anything other than broad market cap indices are forms of active. So there are a lot of tilts. Again, Deborah mentioned ESG. To me, that's a tilt, the form of active that you can take, and you can do that with factors. Factors are a subset of tilts. To me, you're looking at factors where we actually think there's a risk premia, positive risk premia to doing that, whether that's value, size, momentum, whatever that might be. So I think there's a lot of active going on in terms of tilting portfolios and people taking positions off of market cap. Away from necessarily the traditional, I'm going to hire a third-party manager who's going to actively manage that portfolio. And that part, that tilt factor element, I think is going to be a continued growth area for the ETF market, where more and more of those subset opportunities are going to be made available so that people can be in greater control of their portfolios and think about that construction option, whether it be for outperformance or some form ultimately of risk control.
Awesome. And then, but as you look out, again, 5 or 10 years on the pure active side, do you think that the jury's just still out on that? It depends on what the regulators say, or do you think there'll be a role for transparent active that's significant, or will active stay mostly in the mutual fund structure if the transparency requirements stay the same?
Right. I think it's the next level. I think there'll definitely be a process for that. I think particularly in the quant space and others, and there's been a lot of effort to try and bridge that hurdle, and I think ultimately will be. I think the evolutionary process is going to be the broad market cap indices, a variety of factors, a variety of tilts, and then we're going to get to that sort of active structure,
right,
in terms of in the ETF. But it's going to be that evolutionary process of taking the low-hanging fruit first before we get to that back end.
Right.
And Matt,
right.
maybe
Great. Yep, go ahead.
Sorry, I was just going to say, maybe I should clarify that today we do have exchange-traded managed funds, so technically not ETFs, but ETPs, which do offer managers that want to embrace that structure, which is end-of-day NAV plus or minus pricing, to offer non-transparent active. So there is a way to come to market with it. It's just not allowed to be called ETFs by the SEC.
That's exactly right, and there are trading issues around that, but that is a great point. And for what it's worth, I'd hope the SEC, get to the point of allowing non-transparent active ETFs or semi-transparent as soon as possible. I think there are a lot of benefits on the tax and expense side that could be shared down the pike, but we will see. That does take up all of our time today. I would like to thank Debbie Furr, Managing Partner and Co-Founder of ETF GI. It's a phenomenal resource on the ETF industry, and she is a phenomenal resource as well. So definitely check out ETF GI. We'd like to thank Vanguard as well, and specifically Daniel Wallach, Principal Investment Strategist for Vanguard's Investment Strategy Group. Great thoughts on everything from active to factors to the overall outlook of the ETF industry. And of course, thank you guys, the listeners, for tuning in to this weekly Inside ETFs webinar. We'll be back next week. We'll be tackling how to launch and grow an ETF. It should be an exciting topic. It was a big popular session down in Florida at the Inside ETFs 2018 session, so be sure not to miss it. Have a great week, everyone, and talk to you again in a week's time. Bye-bye.
Thank you. Thank you, Matt.
Thanks.